Hello and welcome to the recording on the brief overview of the chapter, and we'll go over a few problems. So, in any case, I'll just kind of briefly go over what we did yesterday in the seminar. So we covered chapter 5 and 6, and we did financial markets and interest rates. So let's talk about we talked about the physical assets versus the financial market, the spot and the future markets, money markets and capital markets, and then we talked about primary and secondary markets. So let's talk about the money market. So what is the money markets? A money market is where financial instruments are exchanged, and these instruments are basically the most liquid of they are highly liquid assets basically, and they are for short term. They're less than a year, and they can be denominated in any currency, and that could be your US Treasury bills, your commercial paper, your CDs, and money market mutual funds. So money markets are short-term debt securities like T-bills and commercial paper, less than 1 year, highly liquid, and therefore short-term. And then we talked about the bonds, and then we also talked about primary versus secondary market. Primary market is when a corporation tries to raise capital for the first time, and secondary market is where the existing shares that are issued are sold on the New York Stock Exchange or on the NASDAQ or any of those other over-the-counter OTC trades. So that's what primary and secondary markets are, and usually financial intermediaries are used. So we talked about the stock market, the physical location versus the auction market, and then we have specialists like the NASDAQ dealers, and these dealers are specialists, and then they hold inventory of the stock. Basically, they hold the inventory, and then you have the bid and the ask prices. Depending on what people want. So they buy at the bid price and they sell at the ask price. So they hold the inventory in stock. And the bid-ask spread is the difference, and that's what is where they make the money. This is where they make the money. So you have investment banks, financial intermediaries, and so on. So we talked about that, and then we also talked about the efficiency model, a theory about the semi-strong, the weak form efficiency. Are markets efficient, and in which form are they efficient? So the hypothesis was in the semi-strong, in the strong form, in the weak form, basically they said all historical information is useless because the stock market does not, the prices reflect only the past, so it's useless to predict future prices, and no, you cannot make above average returns based on that. The semi-strong efficiency says that basically that unless you have private information, you cannot get a better return unless you have insider information. So that's what those were all the different. And the strong form was basically, it said that strong form efficiency, saying that you cannot make money even if you have insider information, and which based on empirical evidence it is not true, because insiders do make a lot of money. So that is chapter 5. So in chapter 6 we talked about interest rates and the cost of money. What influences the cost of money? So the cost of money, as we discussed, this is your NASDAQ and the over-the-counter markets. So the cost of money depends on your 4 fundamental things: production opportunities, how much money can entrepreneurs make, and depending on your time frame of consumption. Amount of risk you take, greater the risk, greater the reward, and the inflation rate that we expect. So what determines the market interest rates? Basically, you have a risk-free rate, which is the rate that would exist on a default-free US Treasury security if zero inflation is expected. Okay. So what I'm going to do now is I'm going to go over the some examples, and then I will not lecture the whole chapter because we did that already. So what I'm going to do is we will go over a few examples of the determinants of market interest rate and what that is. So suppose you have 1-year Treasury bills that yield 6% and inflation is 4% a year. Let me see if I can highlight. Use a yellow highlighter. So you have your 1-year oh, that doesn't work. Okay, that does not work. Okay, sorry about that. Let me go back to the beginning. So suppose you have 1-year Treasury bill at the rate of let me pause here. So let us say you have a 1-year T-bill that yields 6% and an inflation is 4%. So what is the risk-free rate of return? So you know that return on a T-bill equals your risk-free rate plus the inflation premium. So we know what the rate on the T-bill is. We know the rate on the T-bill is 6% and we know our inflation. So we are trying to calculate the risk-free rate of return. Okay, so 6%, so we have the T-bill equals 6% equals X is the unknown plus 4%. So this is your X is what you're trying to calculate. So deduct 4 from each side. So your risk-free rate of return is 2%. So that's one problem. So you can figure out if you know your risk-free rate of, basically the T-bill includes the inflation premium. So the risk-free rate is without any inflation. Our return on the T-bill is with inflation is incorporated in the interest already. So this 6% includes the risk-free rate plus the inflation premium. So let's do another problem. Suppose your real risk-free rate is 4%. I mean, this is without inflation, okay? And your inflation is 3%, okay? And your maturity premium is 10%. It's a function of time. It's 10% times the number of years, basically. T is the years to maturity, okay? So what rate would you expect to earn on a 10-year Treasury security? I mean, what rate would you need? Saying that, hey, at least I need to be compensated for the inflation and also for the risk-free rate times the number of years extended into maturity, okay? So what you're going to do is the T-note yield is your risk-free rate, okay, of the 4%. Plus, you also want to be compensated for the inflation premium of 3%. So you want to make sure you're earning above the inflation so you're not just at the same place. Remember, we talked about the $100 and the 3% inflation. At the end of the year, if you get $103, you're not even better off. You didn't earn anything on your money. So you need to earn the inflation premium plus the minimum risk-free rate of return plus the maturity risk premium. So what is the maturity risk premium? It's the risk that when the bond or the T-bill matures, the note matures, that the default the interest rate risk is not there. So that's a risk you're taking for the length of time. If the interest rate the variations in the interest rate, then your yield is going to go down. So it's 0.1 of 10, which is equal to 1. So your risk, so the T-note must yield 8% for you to be happy, saying that yes, at least I'm covered for my inflation premium, I'm covered for the risk-free rate, plus I'm getting the maturity premium of 0.1 times 10 is 1. So 4 plus 3, 7, plus 4 is 4. 3 plus 1 is 4, and 4 plus 4 is 8% is what you would expect a T-note to yield. So that's how you would calculate that. So the note on the T-note yield is the risk-free rate without inflation plus your maturity risk premium. So let's go over another problem. So let us say your risk-free rate is 2.5%, okay, and your inflation is a constant. It's at 3.05%. So what rate on a 5-year Treasury would you expect? So on a 5-year Treasury, you would expect this plus this. So it's simple. So you need to earn at least 5.5% for you to be happy, saying that I got my inflation risk-free rate plus the inflation is covered. Okay. So let me do the next one. So here you have 10-year bonds which yield 5.2%. 10-year corporate bonds, so these are your risky bonds, they give you like 7.5%, okay? And then you have all 10-year bonds have 1.1% of a maturity risk premium. So that is what all 10-year bonds have, that risk exposure, that the interest rate will change and the yield may go down. And of course the liquidity premium on a 10-year bond is 0.2%. So they want you to calculate and figure out what is the liquidity, calculate the default risk premium. So you need to calculate what is the default risk premium on this bond. So how do you calculate that? So on the 10-year T-bond, they gave you the T-bond rate, the corporate bond rate, and the maturity risk premium plus the liquidity premium. So what you're going to do is basically it is this. Your rate equals your risk-free rate plus your interest premium, okay? This is your interest premium, plus your default risk premium. This is what you're trying to calculate, plus your maturity risk premium plus the liquidity premium. So we know our risk-free, the T-bill rate is 5.2%, which includes the inflation, by the way. So you need to keep that in mind. So this is the 5.2%. So we know this plus whatever X is. We don't know what X is. That's what we're trying to calculate, what the default risk premium is. We know our maturity premium is 1.1, and we know our liquidity premium is 0.2. So 7.5% is the rate on the corporate. So the corporate yield equals your risk-free rate plus the inflation premium plus the default risk premium plus the maturity risk premium plus your liquidity premium. Okay? So we know all these numbers except the default risk premium. So we know the rate on this is 7.5%, and we know the risk-free, on the T-bill is 5.2, but the T-bill includes the inflation premium, the risk-free rate plus the inflation. So 5.2% plus 1.1 plus 0.2 equals 6.5. So deduct 6.5 from this side and from that side, so we arrive at 1%. So our default risk premium equals 1. So I will stop this here, and if you have any other questions, please feel free to send me an email, and I'll be glad to help you. So basically that's what this chapter is about, calculating the risk premiums and being compensated for all the different risks that we take. And we talked about the yield curve, the short-term rates and the long-term rates, and the yield curve for each of them. So the long-term rates are usually higher than the short-term rates because of the time frame, and the risk because of the default risk is higher, and the interest rates may fluctuate. And the formula is, by the way, on figure 6.5, page 190 of your chapter. You will find the corporate bond yield, the same formula that I've put up here. The R star T plus inflation premium plus your maturity plus DRP plus LP. That's how you would figure that out. The only thing you needed to know on this part was the 5.2% included the inflation premium. So that's what you're skipping 6.6, and then we talked about different factors that affect the interest rate, the Federal Reserve policy, the deficits, how the deficits puts an upward pressure on the interest rates, and same thing with the trade deficit. So I will conclude this here, and if you have any other questions, please feel free to email me.